So the last lesson about ethical practice in accounting is public interest. So when we talk about public interest, so we're talking about the accountants. Who are they talking to? Who do they imply to when they say the public? So accountants are entity, they are institute for themselves, they are institute. So everybody that comes to them needs their services. That's why they come to them. So anyone that comes to an accountant becomes a client of an accountant. So for an accountant, they refer to all their clients as the public. So it could be any stakeholder is the public to accountants. The owners of the business, customers, shareholders, whoever is it that needs the service of an accountant, accountants see them as what? Public. So they have to protect the public interest. So let's see how they protect public interest. Yeah, with public interest implies that the society is being valued. So accountants, they value the society. They feel that they have to give a true and fair view of whatever they request from them, because they will base their decision on those things. Do you understand? So businesses, customers, whoever it is, when they go to accountants, they need their expertise to give them financial information. So why do they need this financial information? They need it because whatever they do as a firm or as a business or as an investor, it is based on finance. So they would want the accountants to give them a true and fair view of how the business is. Because it is that it is on those information they will base their decision. They will take decisions on. Do you understand? So accountants view the term public as the following: investors, owners, and business owners of public and private sector organizations. These parties require good information that is free from bias. They need to base their actions and decisions on the most reliable data. So owners of the business, they are the public to the accountants, because the owners of the business will take decisions, will make decisions, and whatever they have to base their decisions on, their actions, their decisions will be based on the information the accountant gives to them. Do you get the point here? So as an accountant, as a business, you need to take actions, you need to make decisions, but you have to make them on financial ground. So to make it on financial ground, you need expertise advice, you need expertise paperwork to be sure that you are taking the right decision. So that is what we're talking about here. So for investors, I said it already, these parties require good information that is free from bias. They need to base their actions and decisions on the most reliable data. So accountants must provide information that are true and fair to owners of the business, because they have to base their actions and decisions on those information. I think that's clear. 2, customers and competitors. So for customers and competitors, here I wrote, these parties rely on sound financial information, as decisions based on this data could have impact on the cost and benefits for them. So for customers and competitors, they need information from accountants too. They need financial information, because it could make them to understand how to spend, when to spend and when not to spend, what is beneficial to them and what is not beneficial to them. So they won't be able to know all this without the help of an accountant. So this is why an accountant must provide a true and fair view of the financial information, which is for the business. 3, the taxpayers also are public. So what do they need for? Why must accountants prepare a true and fair view of whatever information they need? The taxpayers. Who are the taxpayers? Those that pay taxes. Investors, they pay, firms, they pay taxes. Individuals, they pay taxes. Small businesses do pay taxes. So everyone must pay tax. Tax is inevitable. So any financial information that may have negative impact on taxpayers is of interest to these parties. So the accountants also think about the taxpayers. So whenever they have to give information, the taxpayers would need their advice. Oh, are we paying the right tax? Are we not overpaying tax? Is it not that they are charging us too much? So accountants have this information. So the accountants will be able to, put it clear to those taxpayers that, oh, yeah, no, you are paying the right tax. Oh, this is the advice we have for you. Because accountants, they have this information. They deal with finance, so they know more about it. So they know when the business is paying more, they know when it's paying less. So they could give their own expertise advice. Is it clear? So for accountants, owners of the business are public, taxpayers are public, competitors and customers are also public, because all these people, all these stakeholders are clients to accountants. Is it clear?
Yes.
Let me see what we have to do here. So here, okay, we just go down to the concept that will feature in the exams are okay. So we have accounting concepts and conventions. When you talk about accounting concepts and conventions, it means those things that we have, those principles that we have to base all our accounting processing on. That we have to prepare a financial statement, or we have to prepare a financial statement, which could be an income statement or a statement of financial position. But whenever we have to prepare it, we have to prepare it based on accounting concepts, which are the principles to follow when we are preparing our accounts. So what are those principles? We have business entity, we have materiality, we have consistency, we have accrual, we have money measurement and prudence. It's going to be talked about in other classes. So we'll go straight to the exam practice question now. Yeah, the first question says, the first question says, which accounting objective, let's say, which accounting objective states that, I didn't write the question, I got the answer here. It said, which accounting objective states that the information in financial statements must be free from error and bias. The information from the financial statement that we are preparing must be free from error and bias. We have comparability, we have relevance, we have reliability, we have confidentiality. The answer is reliability. So whatever accounting information we are preparing, it must be reliable. And for it to be reliable, it means it has to be objective. It has to be free from errors. It must not be subjective to, oh, I'm preparing because he's my friend, let me just make it look good for him, or let me make it look good. Let them feel like I know what I'm doing. So that means it's subjective. So a financial information or a financial statement must be objective. And for it to be objective, it must be free from error, and it must not be biased. So if it is not biased and it is free from error, then it is what? Reliable. So the principle of reliability, that is the answer for that, which is B. Reliability, sorry. Reliability. C. Reliability, okay. So the second question says, what are accounts produced to show? Why do we prepare accounts? The first option is an accurate and fair view of the business, a true and fair view of the business, a true and honest view of the business, a fair and honest view of the business. We prepare accounts to show a true and fair view of the business. A true and fair view of the business. Is it clear? So the answer is B.
Yes.
Okay. The third question said, who does the term public refer to when used in accountancy? So we have the owners, we have employees, we have customers, we have suppliers. So here, it's going to be the owners. But if we think about employees are not, customers, no. Sometimes customers and competitors, but the first people we think about when we talk about the public are the owners of the business. It is owners of the business. Yeah, owners of the business. Owners. So the fourth question says, which of the following is not an accounting concept? We have materiality, we have auditory, we have objectivity, we have consistency. Materiality is part of accounting concept. Objectivity is part of accounting concept. Consistency is part of accounting concept. Auditory is not part of accounting concept. There's auditing in accounting, but it is not an accounting concept. Is it clear? So the answer is auditory, which is B. And the last question is about professional ethics. It said, which of the following is not one of the main aspects of professional ethics? Integrity is part of the ethics. We talked about it. Objectivity is part of the ethics. We talked about it. Confidentiality is part of the ethics. We must not disclose information of our clients to anyone. So it's confidential. It's part of ethics. Objectivity, we must not be biased when we are preparing our financial information. Integrity, we must be trustworthy. People must trust our job. We must not lie about what we do. So those are the three things about professional ethics. Identity is nothing in ethics. Identity is just who you are. It doesn't have anything to do with professional ethics. Is it clear? So the answer is A. Identity. So that's all about professional ethics and accounting ethics. So we're done with that chapter.